I know exactly what you're thinking. CJ, it's very irresponsible of you to tell people that they don't need to worry about the interest rate. Well, I submit this to you. It's irresponsible of you to not bring out people's potential. It's very irresponsible of you to focus on the interest rate. My goodness, we need to focus on what we can control. We can't control the interest rate, but what we can control is our cash flow. Let's get into it. All right. When you get your income, I want you to do something. Put it inside your line of credit right now. It doesn't matter. You can put it in your line of credit right as I'm speaking, right now. Put it inside of your line of credit right now. Because as soon as you do that, you see you have a balance on your line of credit. You have a balance on your credit card. You have a balance there. But as soon as you put the income inside of your line of credit, inside of your credit card, you know what happens to that balance? It goes down. Do you know what they report to those credit reporting agencies? That this person paid off or paid massively their credit card or their line of credit. You know what the lenders are going to do? They're going to lick their chops. They're going to lick their chops. Why? Because this person just paid $2,000, $3,000, $4,000, $5,000 to a balance, and we've never seen them do that before. Perhaps they got into a certain amount of money. Perhaps this, that, and the other. No, it wasn't that. They just got wiser in their allocation. And so as you allocate your finances correctly, you're going to see lenders raise not only your credit score, okay, but raise your limits. And with that, you want to get into more assets. You see, this credit card here is an asset, but you want to use this asset to get more assets. You're seeing that now, aren't you? That's what we're talking about when we say, hey, you got to leverage what you have, right? Do you see the seesaw now? You got to leverage what you have. Perhaps you don't have a rental yet. Perhaps you don't have a 30-unit apartment building. Not yet. Perhaps you don't have that yet. But you know what you do have? You got a credit card. Oh, yes. And that's where it starts. Okay? Listen, folks. I have investors that are absolutely excited to work with those that are willing to put in the work and then have leverage, that are not afraid of looking at 40% interest rates. Why? Because they know that they're going to get way more in the experience side, in the labor side, in the influence side, in the financial side. You see, even when you, in rental or real estate investing, even if you so-called lose, you still win. Why? Because now you have influence. You've shown people that, hey, you're not afraid to take calculated risks and profit from it. And so therefore, just remember, when I give you a percentage rate like that, 40% credit card or a 40% line of credit, it's not to be irresponsible with. And I don't believe that you're irresponsible. I'm not going to tell you to cut up your credit cards because you're an adult, okay? And I believe in you. Does that make sense? Is that all right to believe in people? So look, when you have your income, you're going to put it inside of your credit card, and from your credit card or your line of credit, that is where you're going to spend on the expenses. Okay? And we're just going to go ahead and abbreviate it EXP. And so that's what we want to do, all right? When you've got, let's say, a house, right, that is, let's say, $200K at a 6% interest rate. And so what is that? About $1,200 a month? $1,199 a month? You got $1,200. What you're used to doing is you're used to taking apart this income. You know, you're going to put it to savings. You're going to put it to the student loan. You're going to put some cash towards the credit card. And then you're going to put some cash towards the $1,200 a month, right? Let's not do that anymore, because that's segregating your cash. It's causing you to go broke faster, and it's really not a wise way of doing things. So let's go ahead and place the income inside of our line of credit. Maybe it's not a credit card, maybe it's a line of credit, personal line of credit, or business line of credit. And what we want to do is we want to take a chunk of that line of credit. Maybe it's $10,000 off of a $20,000 line of credit, and we want to chunk the principal out of that house. Now you're continuing to pay those monthly payments of $1,200 each month. Oh yes, you are. But something happens on the back end. Something happens in the amortization table. How much is going to interest is lessening, and how much is going to the principal is gaining. And so you're taking a huge chunk out of this $200,000 mortgage. So now you're at 190. 6 months later you're at 170. And 6 months later after that, it's just going down humongously. And the bank's like, what in the world? What is happening to our loan? You weren't supposed to get this paid off until the year 31. You know what I mean? 3,100. Because they want you paying forever. You know why they call it mortgage, don't you? Absolutely. Let me tell you why they call it mortgage. Mort means dead, death. And then gage means pledge. Gotcha. But not anymore. Not anymore. This is what we do all day long. Helped over $2 billion worth. Help people eliminate over $2 billion of unnecessary debt. Unnecessary debt. And boy, do I love what I do. If you need help with eliminating your debt, contact us. All right? That's what we're here for. Don't get a consolidation loan. Oh, listen, if your friend has a consolidation loan, could you please show them this video, right? Let them know they don't need consolidation loans. Not anymore. We're going to show them how to get out without getting further into debt and ruining their credit. All right, folks, listen, thank you so much. Don't forget to like, share, and subscribe so that people can know what you know and beyond. God bless, and have a happy new year if I don't see you then.